Well, the RBA has rate pie all over their face. Hi everyone, welcome to the Traders Circle weekly market update. Today is Tuesday the 11th of July, and just before I get into it, you do need to be aware that what I say is general advice only. So it does not consider your personal financial circumstances, and you have to decide if what I'm saying is appropriate for you. So, the RBA last week kept interest rates on hold. They didn't lift at the July meeting, and indeed markets quickly jumped up during the session. They bounced, and our XJO, I think, closed about 30-40 points higher on the day. However, immediately after that, we saw bond yields start to spike in Australia, and we saw our equity market, our stock market, sell down heavily. Now, I think the RBA's got it wrong. I think that basically they thought, oh, we've lifted hard already. We're doing the economic slowdown that we promised. But the numbers aren't suggesting that, at least not from an inflation and an employment perspective. If you go to the RBA website, they'll list their mandate as first, getting prices under control or keeping prices stable, i.e. keeping inflation inside target range. The target range is 2 to 3%. Our inflation is sitting around 6%. And so, that mandate would dictate further rate rises. The second mandate is to keep full employment. Well, full employment, maybe 4 to 5% unemployment, and we're well below that. We're currently sitting at 3.7, 3.6% unemployment, and so the second mandate would point to rate rises. And then, the third and final thing is economic stability. Overall, our economy is actually still doing fairly well. Definitely signs of a slowdown, but you need that slowdown to bring inflation under control. And so I think that the numbers aren't really coming down fast enough to warrant the RBA keeping rates on hold. And that's what the bond market said. Basically, immediately after they kept rates on hold, bond yields spiked. And to me, it was saying, well, now we're going to have a situation where rates are higher for longer and possibly going to go higher than they otherwise would had you not just kept going hard and kept lifting rates. So I think it's really a bad look for the RBA. Obviously, they did say, well, we'll look at further rate rises in future. Well, that's definitely obvious now. And yeah, I think ultimately they had potentially a missed opportunity. Our level of interest rates are well behind, the level of equivalent Western nations. And our CPI growth is still a lot stronger than similar equivalent Western nations. So yeah, I think it was potentially a bit of a wrong move from the RBA. And I think that really the market, the bond market, the stock market as well, displayed a lack of confidence in their decision, basically, with the strong moves that we saw immediately after Tuesday. So we'll contrast that with the US, and we're going to see US inflation or CPI growth on Wednesday night, our time. So not tonight, tomorrow night. And their CPI is expected to come back down to just 3% year-on-year growth. Now that is basically at the top of what we would call our target range, and it's basically showing that the Federal Reserve is starting to get inflation under control. Now that is just the headline number. Core CPI is expected to remain a bit sticky, still above target ranges at around 5%, but also expected to continue to come down. CPI is on the right trajectory in the US. And I think it really shows that the Fed has got a handle on it in getting it under control. But I also think it shows that the market and the economy, US consumers, US businesses, have more confidence in the Federal Reserve in bringing it under control. Part of inflation is, supply and demand factors and an overheating economy, but part of it is also an inflationary expectation. How much consumers expect prices to go up, how much they're willing to pay for higher prices, and how much businesses think they can get away with price increases. And the Fed's been very, very consistent in saying, this is what we're going to do on rates, here's where we're going to lift, here's where we're going to lift, this is how many more we think we've got, this is what we think prices are going to do. And, they've been pretty rapid in getting ahead of inflation and lifting those rates and getting to an overall much higher funds rate than our RBA cash rate. And they've been pretty clear in saying, we think this is where the peak is, we think this is what inflation will do. And so far, the market consumers, businesses have, played ball, listened to the Fed, and I think they've done a much better job of communicating this rate tightening cycle and getting ahead of it than our own RBA. And I think tomorrow's numbers will sort of point to that when we sort of see their CPI growth come in. Overall, the US Federal Reserve is saying 2 more rate rises, mostly, and the next one's going to be at the end of this month, on the 26th of July, almost certainly, and then probably one more. And that's basically what is the general consensus amongst Fed members and also US economists now. And overall, they've been able to bring inflation down, lift interest rates without creating too much economic damage. So sort of 6 months ago, everyone was forecasting a US recession following this tightening cycle, and now things are looking a lot more positive, and everyone is starting to finally believe in the Fed's soft landing that they had been sort of predicting for some time. We're starting to see recession forecasts be lowered, and we're also seeing people who are still forecasting recessions reduce the severity of that recession. So I think really good sign and props to the Fed, I think, for managing this tightening cycle about as well as can be managed. These are always difficult periods. You go back and look historically, things are never sort of managed I guess perfectly with the benefit of hindsight, or things are never as comfortable as you'd hope. Always difficult periods for central banks, and I think the US Federal Reserve has been a real model for central banks around the world in dealing with it. Finally, we've got US earnings kicking off in earnest this week, or at the end of this week, and start of next week. And earnings, year-on-year earnings for the 12 months to the middle of the year are expected to decline somewhat, although they are expected to rise a bit for this quarter, for the quarterly equivalent to last year. Overall, US earnings, for me, I'm not sure are justifying the strength in their equity markets that we're seeing at the moment. Instead, I think the equity markets are pricing off potentially more optimistic forward earnings that we're starting to see. And so if you just basically take current earnings, US markets do look quite expensive, especially given the current level of US interest rates, especially given the current yields on US government bonds, for example. US price to earnings ratios do look extremely elevated. So I do think there are risks to the downside purely from a valuation perspective on US markets. They are north of 20 times reported earnings at the current level, and that is historically a high level, even in a low interest rate environment. In a high interest rate environment, those are very, very high price to earnings ratios. So this earnings season will be an interesting one. Obviously, prices have skyrocketed across the past 3 months, and I think we'll need to see pretty good earnings reports to keep those prices continuing higher from their current high levels in the US. So if we have a quick look at the charts, this is the US S&P 500 index, and this is that 3-month trend that I've been talking about. Very, very strong upwards movement. In fact, it's actually held well above the trend line for the past sort of month and a half. You can draw in an accelerated trend line, and that will probably be tested today, something along those lines. That'll probably be tested by the market in today and tomorrow's session. And overall, I don't generally like to do those sort of accelerated trends. I think the longer term underlying trend is generally the one to rely on. We've also got resistance for the US S&P 500 at 4450. That level would have to break for further gains to look likely. And then, if we see selling, the first potential support level is the uptrend line, currently sitting around perhaps 4350. If that breaks, there's a key support level, previously resistance at 4300. So overall, US markets, and particularly the S&P 500, are heading into the point of an ascending triangle, and eventually we will see that triangle break, either to the upside or to the downside. It's a bit hard to preempt major US movement until we do see a break of that pattern. Overall, like I said, valuations do look a bit elevated in the US, but at the same time, there is that optimistic light at the end of the tunnel in the form of a visible rate rise peak in the coming months. So that does look very, very positive for US markets, and obviously that's why they've been rallying so strongly across this sort of uptrend. If we compare that to our own market, It's been, much more negative here in Australia. We can see the last sort of, 3 months here in Australia, it's been sideways to lower. We did just set a lower trough than the previous trough with the last sort of 4 days of selling. And then obviously we had a very, very strong rebound in today's session. And I think a lot of that comes down just to strength overseas and just to, the severity of the recent selling. Nothing can fall or rise forever. And after 4 days of red movement, we had a bit of a bounce. 7,000 looks to have been the support level we reacted to. And if we do bounce from here, you do have to look at the potential resistance levels at, say, 72.80, and if that breaks, 73.70. It is a little bit early to say, but I would be keeping an eye on a potential downtrend line forming, something like this, and you could maybe extrapolate that into a channel. But I'd be looking at these levels if the market sort of does get to them in the coming sessions, maybe around 7,200 by the time we reach that potential downtrend line. Now, the way we look at trends, you need three touches on a peak for a downtrend, 3 touches on a trough for an uptrend, and that's only 2 touches. But if it does touch that level and fall, that would be a confirmed downtrend. So at the moment, our market does look slightly bullish in the short term, just with today's bounce, maybe retracing some of the losses of the past week. But overall, the recent weakness, I think, points to the RBA perhaps not being aggressive enough in trying to tackle inflation, and as a result, markets forecasting higher rates for longer, dragging out our own forecast interest rate peak, perhaps even lifting our own forecast interest rate peak, and obviously the response from our market was not too fond. So that's it for this week, guys. I hope you enjoyed the video. As always, if you did, please subscribe. It really helps us out. If you didn't enjoy, consider subscribing anyway, and hopefully I'll see you in the next one. Bye for now.